Market guest Dipan Mehta now joins in. Dipan, hi, good morning. Is it time to book profit?
Good morning, thanks for having me.
That's my first question really, because we've seen really big rise for the market from the recent lows after the 5% correction. But is it time to get cautious, or is it time to be just all in and be in equities?
I think from a trader perspective, we've had a spectacular rise over the past few trading sessions on the back of very heavy volume. So to that extent, I think traders may take a slightly cautious stand and kind of, get into neutral position, or at least, square up based on profits which they have made on their trading positions. But I think investors are in a bit of more of a dilemma because the market is just not giving absolutely any chance for them to deploy their cash on a long-term basis. And I did hear your discussion earlier that valuations are certainly on the higher side, and finding the right stocks to invest in is getting difficult by the day. But then the market continues to rally. So I think from an investor viewpoint, it's a tough decision. My sense is that one should still look for opportunities, maybe in mid-cap stocks, wherever the performance has been better than street expectations, visibility is better, and business momentum is there to back the valuations. I think those companies should be preferred, and investors should still gradually perhaps increase their exposure to equity. But for traders, I think one should get a bit cautious.
Okay. Dipan, hi, good to see you, and as always, GAIL, that stock is down 4% after the strong rally that we saw on Friday, and now we presume that it's outside the subsidy net because it wasn't factored into this quarter. Your sense in terms of the 4% dip that we're seeing today, and what sort of call do you have on GAIL as a whole?
So I think what we are seeing in GAIL may happen in the entire PSU oil marketing companies, where there's a lot of euphoria and positivity surrounding the fact that subsidy will come down or will not be shared, as in the case of GAIL. But then at the end of the day, when you look at the basic core business model, there's hardly any growth coming through. I mean, expansions have been put on hold because of various issues, especially uncertainty surrounding subsidy sharing in the past, and on the whole, lethargy on the part of the government to, allow these PSUs to expand capacity because of various reasons. So once you're over and done with the benefit which comes through because of lower oil prices, that gets translated into lower subsidy. And then when investors go beyond that and look at the actual business model and where the growth is coming through from, I think that's where the disappointments are coming in. And, these low oil prices and this subsidy saving and all, you have to, also put in perspective that do we really have diesel deregulation in spirit? And that will get tested once oil prices start going up. So I would say that GAIL and other PSU oil marketing companies, that one-time gain has already been over and done with. And maybe investors should perhaps kind of move on to other stocks and, wait and watch these companies as to how their actual core of business operations are taking off.
Okay, so Dipan, one of my favorite questions, what should be done with regard to portfolios now between banks and IT, for example? We've seen how banks outperformed so much in the month of October, but IT started to show signs of revival by the end of the series. In November, what do you think would give better returns, IT or banks?
Not just November, I think entire next 3-4 months. Banks will outperform IT by a huge margin, I feel. And in IT, when we see the entire spectrum of numbers which have come through, you get the impression that although the managements are great at, delivering and their commentary and, speaking well about the industry, but there are wrinkles and there are challenges. Clearly, profit margins are under stress because you continuously have wage increases and there's hardly any pricing, price increases. Nor do these companies have any, pricing kind of capability or pricing power, so to speak. So the levers are gradually reducing for the IT companies in terms of maintaining their margins or increasing their volume growth. So I would get extremely skeptical about IT companies and extremely cautious as well. See, markets tend to go up and that will lift, rising tide will lift all boats, and IT may continue to do well. But when we're looking for alpha, I think that's better in the banking stocks, where surprisingly a whole host of banks have come out with excellent set of numbers. Suddenly all the various levers for their profitability are coming alive, be it treasury, be it core banking, be it other income, be it lower provisioning. So there are various reasons why why most banks have done well. But on the whole, I think these results show a lot of promise for banks. And if by chance interest rate reduction does kick in earlier than what Street is expecting, or if bond prices increase and we've got lower yields, at the same time if the economy also tends to pick up and credit growth picks up, a lot of things going positive for banks and NBFCs. So you have to clearly shift out of IT into banks, and I would stick out my neck and say that maybe be slightly overweight, maybe 25 to 30% in banks and NBFCs in a long-term investor's portfolio.
Are you a bit disappointed by seeing the October auto sales numbers which have come as of now?
Yeah, well, these numbers keep on fluctuating depending upon seasonality, depending upon when the festivals took place this year and last year, and depending upon new models introduced by the various auto companies. So you have to keep this under watch. 2-3 months of disappointing numbers, and then suddenly you need to review your holdings in all the auto companies. But one bad month doesn't mean that the industry trends have gone negative. Sometimes we've seen in the past 2-3 numbers, monthly sales numbers are flat, and then suddenly 2-3 months are excellent. There's a lag effect also which comes into play, year-end effect which comes into play. But broadly, I think it's pretty clear that more and more vehicles are being sold in this country, and these are at these elevated levels of interest costs. Imagine 1 year down the line when interest costs are lower and overall economic trends are better, then what kind of volume growth will take place. And most of the auto companies have adequate capacity, great operating leverages, fantastic balance sheet, good corporate governance standards, hardly any need to dilute capital. So a lot of things going in favor of auto companies, and one shouldn't just have a negative view because one monthly number has been kind of flattish or slightly disappointing.
Okay, finally your call on Bharti Airtel, Dipan. That stock has corrected over the last couple of days, and we saw quite a bit of delivery based selling also on Friday.
Well, I think about a quarter ago or so I was getting a bit optimistic on Bharti, but I think this result has clearly shown that we need to throw in the towel as far as Bharti is concerned. And if you want to play the telecom space, which is really quite exciting and one of the few segments where valuations are still kind of reasonable and still you get the benefit of rising domestic consumption, the best play remains Idea. And really there are too many unanswered questions as to how Africa is going to turn around, and eventually over 2-3 year period how they're going to recover their costs. And among the softer aspects which come to mind is that I would say that a lot of top level management mind space may be going towards African operations. Some of their talent also they may be shifting to get those businesses turned around, when they should be concentrating on the Indian market, where you're going to have a formidable rival to deal with in a few months in the form of Reliance. And I would say that Idea and maybe Vodafone, although unlisted, are better placed to take on the emerging competition which may come in from there. Having said that, one really doesn't know how this competition is going to play out in the Indian market. But my sense is, and looking at the industry over the past a few years or so, there will be some initial pressure on profitability of telecom companies. But I think over a 2-3 year period, it's going to be a great play on rising internet consumption and e-commerce and Internet of Things. Whatever your telecom companies are going to be the real providers of internet connectivity rather than the cable companies or standalone ISPs.
Okay, fair enough, Dipan, for all those interesting stocks and all those interesting views that you have. But any disclosures?
I think we spoke about a range of stocks and industries, and it's fair to assume that our portfolios and our recommendations are skewed based on what we've just discussed.
All right, fair enough, Dipan. We leave it at that. Thanks very much for joining in.